partner and chief investment strategist at Cresset Capital. Jack, traders overwhelmingly believe there will be no move tomorrow, so that wouldn't be a surprise. So but why must investors pay such close attention to what happens and what Chairman Powell says tomorrow during the show, during his news conference?
Yeah, you're right. It's all about the outlook. It's all about the language, the nuance. Right now, we started the year with investors anticipating 2 rate cuts this year. That has now come down to 1. We believe that the Fed should reinstate the 2 rate cut program, but we'll see what he says. I think that the connection that a lot of investors fear between high oil prices and inflation just isn't there the way it used to be many years ago.
Well, let's talk about that. I mean, there used to be this very tight link between oil prices and inflation. If oil went up, and still to this day, oil is in everything, tires, all kinds of production equipment. So why is it thinner now? Why is that connection thinner and not as important?
Sure. So there are a number of factors. If we, dial back to the 70s, the late 70s, mid 70s, what we found was that a much higher percentage of the American workforce were parts of private sector labor unions. These labor unions had cost of living adjustments built into their contracts. So all it took was, a spike in oil prices to then kick the CPI up, 1 month. That then gets into labor contracts, and all of a sudden you have a wage and price spiral that ends up with, in a couple of cases, double-digit unemployment, double-digit inflation.
Yeah, exactly. It's not as tight, so the market probably isn't as fearful when you start to see oil prices go as high as they have. I mean, last week, of course, the beginning of the war, everybody was incredibly nervous. They still are, but not at such a heightened level. Jack, could I just ask you about technology? Because we're looking at the XLE. We're looking at a broad-based rally today, so almost everything is moving higher. We've got some weakness in healthcare. But when you talk about technology, what areas do you think are still really strong? Because let's just take NVIDIA, for example. NVIDIA made some huge announcements yesterday, not the least of which is that they said they would bring in $1 trillion in revenue next year from their existing chips, not even the new ones. And yet the stock is hard to move.
Yeah, so you're right. I think what we have is perception weighing against the group. I just did an analysis late last week on the Mag 7. And if we assume no multiple contraction or expansion, we're looking at a sector, Mag 7, that is 10% undervalued relative to 12-month forward earnings. So even there, this is not a sector that's expensive by any stretch. And if you broaden that out to the S&P, we have, we're looking at mid-teens earnings growth between now and a year from now, which suggests, again, if interest rates stay around where they are or even come down a little bit, we could see, 10 to 15% growth in markets over the next 4 quarters.
Well, what do you like here? Because what I found really interesting is one of the names on your list is C.H. Robinson. That's a logistics company. It was just about a month ago that all logistics names and trucking companies went completely face-planting because there was one single report, a research report that said, oh, logistics companies are going to be completely disrupted and destroyed by AI.
Yeah, I think that was, Liz, a little bit overdone. What we like in here are very strong, high-quality companies that are generating a lot of cash, and so much cash that they have really consistent dividends and dividend growth. And so historically speaking, dividend growth has been, consistent and outpacing inflation over a long period of time. So C.H. Robinson, again, probably caught in the crosshairs of the AI trade, so to speak, about a month ago. But again, kicking off strong cash, has a 1.5% dividend yield, growing a little more than 1%, we expect, over the next few years. So pretty consistent story there. Chubb, everyone knows Chubb, high cash flow generator, 1.2% dividend yield, growing it. We expect 7.6%, well ahead of inflation. And of course, General Dynamics. Now, I don't want to necessarily say, hey, this is a table-pounding opportunity. I do think that certainly defense stocks are well positioned, but we have to keep in mind that the defense industry is moving. We're moving toward these drones and other markets, and we want to make sure that the established players can keep up. Nonetheless, 1.8% dividend yield, growing. We expect at about a 5.7% growth rate. This is of its dividend over the next 3 years. So
not a
very
bad
strong
performance here
players.
for General Dynamics, up 35% over the past year. But I think you're right. There are a lot of startups, one of which we're going to be talking to today that just went public in that defense area. Very fascinating to see how the smaller companies are either partnering or beating some of the big established ones. Jack, great to see you. Thank you very much for joining us. And you get points for the green. It's forest green, definite points.
Thanks, Liz.